everyone. Welcome to Eye on Insurance, an IBN Money special on life insurance. Indians are lapping up insurance policies like never before. So what is this flurry of activity all about? How much do you need? And from all the piles of information out there, what should you really know? That is what we'll be talking about today. And yes, as always, we're flooded with solid viewer queries. To take us through it all, we have joining us Mr. Karthik Jhaveri, an insurance and financial planning expert. Mr. Jhaveri, welcome to the show. We're going to start straight away. Now, people feel quite strongly about insurance. Let's hear what this viewer has to say.
Hello, I'm Renu. I'm a public relation executive. I think insurance policy is just a fox, and I don't know why I should be convinced. I am not sure whether I should buy an insurance policy just because my agent says it is good for me. I'm not convinced about the idea of this whole insurance policies.
Okay, so in a nutshell, is life insurance really needed, or are we just in for a waste of money, Mr. Jhaveri?
See, life insurance is a critical necessity, yeah? But having said that, not everybody really requires life insurance. Now, the reason why an agent says that life insurance is an important thing and that you must buy it is because there is a little bit of a vested interest and the insurance agent is trying to sell the policy. But what we've got to see is what life stage are you, what kind of dependence do you have, do you really have somebody who is dependent on your income, so on and so forth. These are the questions that really need to be considered and answered appropriately before you really decide whether insurance is there for you or not. It's not a farce, it's a critical necessity, but whether you need it or not depends on a lot of questions.
Okay, that said, here's the first big query that a lot of people have asked, and one such viewer is with us. Let's hear him out.
Hi, I'm Prithvi. I'm a software engineer. I earn about 5 lakhs a year. How much do you think I should invest in insurance?
Okay, let me first clarify one thing. You are not going to invest in insurance. Insurance protects your life. You are going to buy a contract. So when we say that we are going to invest in insurance, that itself is a wrong word to use. Now, let's say you have your income, like you say, is 5 lakhs. Okay, what are we trying to really protect? Is somebody going to be dependent on your income in the case of your death or inability to earn? And is your family going to be deprived of that money? If the answer is yes, yes, you need insurance. How much? How much do you spend on your monthly expenses? So your family depends, out of your 5 lakhs, it depends on about, say, 20,000 rupees of your money as insurance or as a monthly expense. Now, a very simple ballpark calculation. You need 20,000 rupees a month, which makes it to about 2,40,000 a year. If you were to invest this money in a bank deposit, okay, and earn about 5% rate of return, then the answer that you get is the amount of cover that you need. Very simply put, you need an insurance cover of 2,40,000 divided by 5%, and that becomes about 24 lakhs.
Karthik, can you just repeat that? You said that you need an insurance cover. Can you give me the calculation again that you gave me?
Sure. See, what happens here is, let's say your family needs 20,000 as your monthly expense, right?
Okay.
So if you would die, then your family is going to be deprived of that 20,000 rupees per month, correct? Okay. That works out to 2,40,000 a year.
That's right.
Is that right? Okay. Now, you need to do something or have enough insurance by which, let us say, when you die, then your family gets that money, you invest it, and you get 2,40,000 income out of that. Correct?
That's right, Karthik. So,
okay.
So you're basically talking about covering those losses that you can't afford.
Precisely. Precisely. If somebody is dependent on your income, then that's what you need to cover for. So if you can earn 10%, if your beneficiaries can earn 10% on the money, then you need 24 lakhs of insurance, which will effectively give you 2,40,000 per annum. Okay. If you can earn 5% on that through a bank deposit, then you'll need double of that, which is 48 lakhs.
Okay, so you've given us an idea as to how the calculation would go. But that said, there's a jungle of insurance types out there. Just to name a few that I've heard: term, life, life without return, endowment, so forth. Can you therefore outline the most pertinent and also tell us about their utility?
Okay. Look, life insurance, let's understand it. You pay a certain amount of money to the insurance company, they're going to cover your life. Okay? That's really pure and basic insurance, which is known as the term life insurance, without return of premium. This is a category of product. You're going to pay a premium, you're going to get nothing back, but your life is covered and it's really cheap. It's as cheap as maybe about 400 or 500 rupees for 1 lakh of insurance cover. Okay. So that's term life without return of premium for you.
So that's a basic,
now,
if
you tell the company, that's the basic pure vanilla product.
All right.
Or product category, let's call it that way. Now, let's say you tell the company, look, I'm paying you premiums, I need the premiums back as well. So the company will tell you, okay, you take a term life with return of premium, which means what? You're going to get all your premiums back, but you're going to pay a little more to the insurance company. Okay? The next step is you tell the company, I'm going to pay you a premium, but I want some investment returns as well. So I want investment plus insurance as a combination. So the company says, okay, why don't you buy an endowment product? And as a result of which I'll cover your life, plus you're paying me more premium, so that additional premium that you will pay me, I'm going to go ahead and invest it, and when I invest that money, I'll be able to give you some bonus and returns at the end of the term of your policy. So that's endowment for you. Okay? Now we go a step further, and what happens here is that you tell the company that, look, don't only give me some money at the end of it, I need some money in between also. Give me some intermittent cash flows. So the insurance company creates a product, calls it a money back policy, and that's the money back policy which you will buy. But it's the most expensive policy because your life is covered. You've got saving benefits to that. You've got maturity benefits to that, which is, at the end of the policy, they've got to give you money. Plus, you want intermittent cash flows as well. So all these things obviously make the product so expensive. This is the other end of the spectrum, if you like.
Basically, the more you're getting back, the more expensive the actual policy is going to be, right?
Precisely. So if you could buy a term life for 500 rupees in a lakh, you're going to spend maybe about 10,000 rupees for a lakh of insurance cover for a money back policy. And this is for, say, approximately if you're 30 years old,
Okay, and those are the main ones that you're going to be telling me about. What about whole life annuities?
Okay, now annuity is a product wherein the company will pay you a monthly stream of income. And how does that work? You either pay them a lump sum, okay, if you have the lump sum cash, or you pay them on a monthly basis or a yearly basis, just the way you pay your insurance premium. And after a certain number of years, they will start giving you the stream of income. Essentially, annuity policies are used for retirement-oriented benefits.
Okay.
All right. And now, whatever other policy you have, a child plan, woman plan, and then you have your whole life plan. Now, all these plans are a mix and match of these basic products.
Fine, Karthik, I'm going to go on to asking you about your recommendation for 3 broad profiles. There's young and single, and working, and married with kids, and retired. So which of the policies should each of these prefer?
All right. The single person, firstly, like I said, he may or may not need insurance. If there is a dependency or if he has a loan, then yes, he requires insurance. The kind of policy that he should buy is a term life without return of premiums. That's the best thing that you could do, and hunt around for the cheapest product in the market, and that's your best deal.
Okay, I'm just going to repeat that. A single person who does not have to worry about dependency should go for figure out whether they have any dependents, and the easiest vanilla product for them to go for is term life
without return of premium.
Without return of premium, that's right. Okay, fine, all right.
Yeah, see, even if he doesn't have the responsibility, he might get married, he'll have children later on. That time the premiums will be a little higher. So it's good if he gets into it right now, if he really wants to.
Okay.
Now, let's say we talk about somebody who's married and got children, right? Now, again, your dependents are dependent on, really speaking, your income. In today's scenario, endowments, money bags, whole lives don't really make a lot of sense because the way these policies invest the money, it tends to give you a saving return of about 4 or 5%, which is pretty much equal to or less than inflation, which is why it's not warranted that we enter into such policies for now. The best option would be to stick with the term life, even for a married and, with a family kind of a person.
Okay.
If you talk retired people, then obviously the retired person would look at the annuity kind of products that are available in the market, which tend to give him a regular stream of monthly income.
Okay, well, Mr. Javeri, thanks for being with us for this segment. We're taking a short break, but coming back with how insurance stacks up in terms of savings and